Hello my fellow investors and welcome to a quick midweek update here. I don't normally give these midweek updates, but we have the FOMC interest rate meeting yesterday where Fed came out and gave us their take on the future of the interest rates, and I thought I would just give you a quick update because after they kept the interest rate at zero, which was expected, the market stayed pretty much the same yesterday. But then Powell, the Fed chair, he came out and he started talking at the press conference, and all of a sudden the market started to drop. Now, why was that? I will combine the answer to that with a little thing about the video I made the other day. You might recall the video here with interest rates and historic stock prices, where I kind of showed in the stats that when we look at history, we can see that over the long run, when we have rising interest rates, we also see a rising stock market. And I've gotten some questions in the last couple of days saying, yeah, well, why is the market going down then? Why, when we are seeing rising interest rates, why are we not seeing rising stocks? And first of all, let me just clarify, if I didn't tell that clear enough the other day, these statistics here are over years, months and years. So this is not over 3 days where we have rising rates and then we should see rising stock prices right away. This is the overall tendency. So we can easily have some months where the interest rate is going up and at the same time the stock market is going down. So just to clarify that. But why did the market go down yesterday? Well, what actually happened was that the market had hoped for some clarity. They had hoped for Powell coming out saying this and that date we will raise interest rates, we will start our balance sheet tapering, the reduction in our balance sheet, we'll start that at this date and we'll do it in this way. Because what the big institutions really like in the market is clarity. They don't mind too much that the interest rate is going up. Of course, some stocks will go down then, but they don't mind it too much. What they do want is they know what to price in. They want to know what to put in their spreadsheet so they can calculate their fair value of different stocks. And yesterday, when we heard Powell talk, it was kind of a nothing burger. I know why he did it, because he wants to see if the economic growth stays the same. We have the GDP numbers coming out later today. He wants to see that all the numbers are going in that direction as we can see right now, and that it's not just a result of some stimulus package that then wears off. So he wants to give himself a bit of a wiggle room. I get that. But the market hated it, because they wanted some dates, they wanted some facts, and what he gave them was pretty much nothing. What we can see in the FOMC countdown here, you can see this is the next meeting at the 16th of March this year, and you can see what the market is pricing in. Let me just get this one up here. You can see that the market says that it's pretty much completely unlikely, 0% chance that the interest rate will stay at zero. There's an 87.6% chance of a single rate hike, and there is a 12.4% chance of a double rate hike. And actually yesterday this was only 6%, so this has gone up now. But what happens from now on and until the 16th of March is all sorts of speculation, all sorts of rumors. And I predict that the market will be rather volatile. Sadly, we all like a less volatile market that is a bit more predictable. But it is what it is. Now, when we look at the interest rates right now, we can see that all of the short-term interest rates are going up. So what we can see here is the two-month interest rate, 6 months, 1 year, 2 year, 3 year. They are all going up, and that is because people are expecting Fed to raise the interest, and the shorter the time frame, the closer it mirrors the Fed interest rate. Whereas when these longer-term interest rate falls, the yield up here at the 7, 10, 20, 30 year bonds here, When they drop, it is because people are a bit nervous. They don't know what to expect. So they are buying the security of some longer term bonds here. And when the bond prices go up, the yield goes down. So what we can see here is what I talked about and have talked about in several videos. It is the potential flattening of the yield curve, meaning that normally we see a rise from the lowest time frames to the longest time frames, and right now the difference between the lowest time frames and the longer time frames are flattening out, and this is not a good sign. We want a good natural interest yield curve here. When it is flattening out, it shows us a great deal of nervousness in the market. So this is what is happening right now. And when we're looking at the stock charts here, or this is the S&P 500, you can see that the S&P 500 was nicely up yesterday, and then Powell started to talk and it was sent down. And over the night here, the futures were also sent down. But I guess what is happening now is that people realize, even though Powell was speaking kind of vague and not really giving us any directions, he actually signaled that the economy is good, and he pretty much signaled the first rate hike here in March. I would be completely surprised if that doesn't happen. But what people have hoped for was also a bit of knowledge, a bit of insights into if they will start selling out, or at least do a tapering of their balance sheet. They don't need to sell bonds to make a tapering of the balance sheet. They have all of these bonds. They have been buying bonds up a lot these years, and in the last months they have scaled down the purchase of new bonds, so they are pretty much stable. And here in March, this tapering of the purchase program will be over. Now they don't have to sell bonds to start to lower or reduce their balance sheet, because all of these bonds, they are basically debt, and debt expires all the time. So if they just stop buying new bonds, there will automatically be a reduction of their balance sheet simply due to bonds running out and expiring. So that is one way they could do it without making too much fuss about it. But the market had really hoped for some direction as to what they wanted to do here, and we got nothing. So that is why this volatility kept going. And I dare to predict that over the next 5 to 6 weeks, until the 16th of March, we will see. I have no idea of the direction. It can go all ways, but I predict a lot of volatility. Now, what we can see, what is a bit interesting, is that in our subscription service here on Invest Like a Guru, remember that it's a 30-day trial. There's a link below here. But in this, we can see that we have the weekly, monthly, and quarterly momentum models. And the monthly and quarterly momentum models, they rotated into the same set of stocks here on the 1st of January. And then the monthly model will rotate again here on the 1st of February, whereas the quarterly will keep the stocks the entire quarter, first quarter here. The weekly momentum, of course, is rotating once per week. What we can see, because we are monitoring all of these stocks, is that many of the stocks we have bought are coming out with some very, very good earnings and estimates for the rest of the year. And there is a tendency right now that with the rising rates that we know will come, the more the companies with most debt and with less earnings are the ones that are dropping in price. We can see it in the RK ETF and so on. All of these innovative high-risk growth stocks, they are dropping. And we can see that the stocks we are having right now, it's not that they are not going down with the market. I can say that the model that we are investing in ourselves, that we will be basing our upcoming fund on, that is only down something like 6.8% or something like that in January so far. And we can see that the stocks in that portfolio, they have some very, very good earnings announcements just within the last couple of days. So that tells us that these models are automatically rotating into, you could say, value stock, but at least solid stocks. Some of them are tech and so on. So some of them you might not call real value stocks, but we can see that it is solid, well-earning stocks. And that is all we need to know. We don't have to think too much about it. The models are doing all the work for us. I hope this gave you a bit of a fresh view on the Powell Fed FOMC meeting yesterday. It was a bit of a mess just afterwards, but I think the market is starting to pick up direction, and if they can keep up what we are seeing right now, I think we can get some gains actually in the upcoming time. Now, as of if we can keep the gains for weeks, a month, I have absolutely no idea, and no one does. That's all for now. Take care of yourself and your money out there, and I'll talk to you again shortly. Bye for now.